Look at this number, 7.7%. India's GDP growth, the highest level we've seen in 4 years, a number celebrated by politicians, applauded by economists, and embraced by investors. At first glance, it looks like proof that India's growth story is stronger than ever. But what if I told you that the same data being used to celebrate India's economy is also sending a warning signal? A warning so important that the RBI, rating agencies, and institutional investors are already adjusting their expectations. Today, we're going to uncover that warning. And by the end of this video, you'll understand why India's strongest growth number in 4 years might actually be hiding its biggest challenge. I want you to look at these two numbers on the left, 7.7%, on the right, 6.4%. One represents where India has been, the other represents where India is going, and markets care far more about the second number because investors don't make money from yesterday's growth. They make money by correctly predicting tomorrow's growth. The paradox is simple. India just delivered its strongest growth performance in 4 years. Yet economists are becoming more cautious. Why? What changed? Because if everything is going so well, why are future expectations falling? Let's dig deeper. This chart tells a fascinating story. FY23, strong growth. FY24, even stronger. FY25, a slowdown. FY26, a rebound back to 7.7%. Most people stop looking here, but that's a mistake. Because the most important bars on this chart are not the green ones. They're the forecast bars. Notice what happens next. 6.6%, 6.4%. We're no longer accelerating, we're decelerating. And that shift changes everything. The question isn't whether India is growing. It clearly is. The question is whether growth momentum has already peaked. To answer that, we need to understand what the RBI is seeing. Let's play a quick game. If growth slows, what should a central bank normally do? Cut rates, encourage borrowing, stimulate investment, support growth? Simple. Except that's not what happened. The RBI kept rates unchanged, and that tells us something important. The RBI is worried about inflation. Look at the inflation projection, 5.9%. That's significantly above the level policymakers would like. So now the RBI faces a dilemma. Growth is slowing, inflation is rising. And when both happen together, central banks lose flexibility. That should immediately get your attention because this isn't just a growth story anymore. It's becoming an inflation story. And this might be the most important chart in the entire presentation. Look at the green line, growth. Now look at the red line, inflation. Notice what they're doing. They're moving toward each other. Growth is falling, inflation is rising. Now, let me be clear. I'm not saying India is entering stagflation. We're nowhere near that. But direction matters, and the direction is becoming uncomfortable. Every percentage point inflation rises, reduces purchasing power. Every percentage point growth falls, reduces economic momentum. And if these two trends continue, the pressure on policymakers becomes enormous. But what is causing inflation to rise in the first place? That's where the real story begins. Imagine waking up tomorrow and discovering that fuel costs have increased across the entire economy. Every truck, every factory, every airline, every logistics company, every farmer. What happens next? Prices rise. That's exactly what expensive oil does. And right now, Brent crude is hovering around $93 per barrel. This isn't just an oil story. It's a profit story, an inflation story, and eventually a stock market story. Here's the chain reaction. Oil rises, input costs rise, margins shrink, prices increase, consumers spend less, growth slows, one commodity, 5 consequences. And that's why the RBI calls this an energy trap. The market is behaving like a jury that hasn't reached a verdict. Bulls see strong GDP growth. Bears see slowing momentum. And the result? Indecision. Look at Nifty. Support near 23,200, resistance near 23,700. The market isn't breaking down, but it isn't breaking out either. Investors are waiting for clarity, waiting for inflation data, waiting for oil prices, waiting for the RBI. In other words, the market is telling us exactly what the economy is telling us: uncertainty. Here's a risk most retail investors never think about. Global capital. Money flows where it gets rewarded. And today, the difference between Indian and US bond yields is much smaller than it used to be. That matters because investors now have alternatives. If that gap narrows further, foreign investors become less willing to take Indian market risk. That can create pressure on the rupee, pressure on imports, and ultimately pressure on inflation. It's not a prediction, it's a risk, but it's a risk worth watching carefully. Now, let's be fair. The India story is real. GST, infrastructure spending, PLI schemes, digital public infrastructure. These are genuine strengths. The bulls are absolutely right about that. But here's the problem. Even the strongest economy cannot fully escape external shocks. Oil doesn't care about GST. Geopolitics doesn't care about infrastructure spending. Global interest rates don't care about domestic reforms. And right now, external pressures are becoming stronger. That's why this debate matters. It's a battle between long-term strengths and short-term risks. I took everything we've discussed and scored India's position across 6 critical areas. The results surprised me. Not a single category improved. Some weakened slightly, others weakened significantly, but one stood out: energy security. That is India's Achilles heel. And until India reduces its dependence on imported energy, this vulnerability will continue influencing growth, inflation, and market performance. So, what should investors do? First, stop chasing headline GDP numbers. Markets price the future, not the past. Second, prepare for volatility. The next year is unlikely to be as straightforward as the previous one. Third, focus on companies with pricing power. Businesses that can pass higher costs to customers tend to outperform during inflationary periods. Fourth, protect capital. In uncertain markets, survival comes before returns. And finally, watch 2 numbers every week: oil prices and foreign investment flows, because they will tell you more about the market's future than any quarterly GDP report. Here's the uncomfortable truth. The biggest risk facing investors today isn't pessimism, it's complacency. The belief that because India has grown rapidly in recent years, it will automatically continue doing so. History doesn't work that way. Every growth story eventually encounters constraints, and those constraints are becoming increasingly visible. Energy dependence, imported inflation, global uncertainty, tighter capital flows. None of these mean India's growth story is over. Far from it. But they do mean that the easy part of the story may already be behind us. The real question isn't whether India can grow. The real question is whether the market has already priced in too much optimism, because the 7.7% of yesterday made headlines. But the 6.4% of tomorrow is what will determine where markets go next. This has been The True Analyst. If you found value in this analysis, subscribe. And tell me in the comments, are we looking at a temporary slowdown or the beginning of a much deeper reset in expectations? I'll be reading every response.